Hey everyone, Nathan here. Thanks a lot for tuning in to this evening's webinar. I can see there's lots of people online, which is really cool. Just a bit of a shout out in case anyone's got any technical difficulties. If you can just let me know that you can hear and see me. Sean, thanks for the heads up on that front. And we will get started. Everyone can hear me? Yeah, cool, awesome. Cool. Well, hopefully everyone is having an awesome 2021 so far. What a great year 2020 was, and lots of cool things, in the community that I've seen, and lots of interesting things happening in the property market. So, yeah, getting started. I have got about 50 slides here on the slide deck tonight, and gonna get straight into them. So, the agenda of this evening, obviously about how to build a portfolio today. I understand I've put lots of videos out over the last decade about how I've built my own portfolio. I've built portfolios for investors, but people are wondering, can you still sort of build a portfolio similar in 2021? And it was actually inspired by one of our community. Andrea had asked through, she had all these friends that wanted to see if they could do the same sort of thing, and I thought, why not put together a presentation on that. So yeah, so some of the things I want to talk about tonight is why build a portfolio in 2021 or at any point to be frank. The difference between each of the decades, so 2001, 2011, 2021, how to build a strong strategy. Why property has never been cheaper. All these people complaining, oh, property is too expensive, I can't get into a property. Well, I will talk about that this evening. Want to talk about, I was thinking, what was I presenting 10 years ago? I actually used to, I don't do seminars, I don't do anything like that. I did do some seminars back in the day, and I pulled apart a few of my old slide decks, and I think it will be fun for us to have a look a little bit at that, because even though a decade has passed from that and the decade that was prior to that, the same fundamentals apply no matter what market. I'm going to talk about how you can build a portfolio with sort of none of your own money. It doesn't apply to everybody, but it does apply to some. How you can start a portfolio with 30 grand, 100 grand, 150, and these here are sort of doubled over, but yeah, everybody's running a different everyone's running a different race, everyone's in a different position. We all go home to a different place, we all go to different places to work and do different things. We've all got different lives, but there's some fundamentals that are very similar there. So going to be talking about actually some of those points are actually inside these, so I stacked them in behind. Going to be talking about the importance of the right team around you and some properties that I have currently available. So I've got Steph, you said that you can't hear me. Can anyone get the audio working? I haven't had any other complaints. Normally if something goes wrong, I see lots of complaints, so maybe it might be restart and hop back in the presentation. But if anyone else is having problems, yeah, everyone else is saying it's working fine as well. So yeah. So yeah, why build a property portfolio in 2021? Or any time. So for me personally, when I first started, and I understand I've got a lot of new people that are coming out of the woodwork and looking at B.Invested. You may be around here for the first time, not knowing who's this odd guy that's chatting crazy things. So a bit of a background for me, for those of you that are fairly new watching throughout 2021 and 2020. I grew up in Western Sydney. My parents were average family. I wasn't poor, but I wasn't wealthy. And I saw my family working very hard and not getting ahead in life. I realised rich people had property. I wanted to be rich. Definition of rich is in wealth with currency and being able to have options in life. So I went out to try and build a property portfolio. I wanted to be retired by the age of 30. Thought it was impossible. There was no such thing as YouTube, Facebook, webinars. Technology wasn't out there. I just started pounding the pavement, and I had a strategy that was, sort of cool for me at the day, and that was to buy 10 properties by the age of 30. I thought it was impossible. Ended up doing it, smashing it. Quit my job at 24. Made my first $1 million in Mount Druitt, of all places, in Western Sydney, and today have hundreds of properties. And yeah, that's expanded from normal little residential houses. I've never played Monopoly. People always say it's a real life Monopoly, but I have never played it, but I understand there's like red hotels and greenhouses or something like that. Properties have changed over the years, but still the fundamentals are very, very important, and I still work with those same fundamentals today, no matter what asset I'm buying. So there's also things that that I've learned along the way, whether it be understanding how debt works, whether it be understanding the financial markets, whether it be sort of looking at when I first started buying property, I thought you've got to buy a property and you've got to pay down all the debt and get rid of it. And that's what everyone told me to do, because debt is bad. And I started paying off my first one, and then I was like, how do I get a second one? I was saving up for a second one, bought a second and a third one, and then I was like, this is slow, whatever. And I realized what equity was, and grasping the concept of debt, being good or bad, is a big life changer. All successful countries, businesses, people out there, is just a form of leverage. Debt with the right fundamentals is really well off, and you can do really great things with debt. So one of the biggest hurdles that I had at the start was understanding how debt worked, and today I like to think I'm an expert on it, because I have about $18 million worth of debt and a whole portfolio worth about $80 million. That's excluding any other sort of assets or financial instruments that I have. So if I had bought my first property was $248,000 in a place called Heversham. If I had worked hard, paid off that loan, it would have taken me, I was earning like 40 grand a year. I would have, wasted probably, 7 years of my life paying down that mortgage, and I would have one property bringing in, $200 a week at the time. What I realized is every time, I was fortunate that I couldn't sign a contract till 2003 because I wasn't 18 yet. And in 2003 was the end of the Sydney property boom. So it crashed in 2003. And I was buying, like, it actually crashed in 2004 or 2005. But when I bought my first property, it was like right at the peak of the market. I still did well out of it. Didn't lose any money, but it was just from buying well. But I often think, I refer back to, as I was saving my deposit up, going, I wish I could buy a property, but I can't sign a contract yet. Every time I saved up 10 grand, the property was going up 20, 30, 40 grand. So it was a bit upsetting to see that. And the same thing is occurring today in 2021. We're going through a property boom. Believe it or not, we are in a big property boom. So I realized that as the market had crashed, I was accumulating and building my portfolio, that I was, needing to be aggressive in understanding how the debt works. So, with it, looking at, other investors, like why I wanted to have property, I thought if I had 10 properties that returned $300 a week, $100 a week of that being positive, that would be 50 grand a year income for me. That's when I first started investing. And then my goals naturally grew from there. So I started off, I wanted to get 50 grand a year, thought it was possible, got 50 grand a year, quit my job, wanted to push it higher and higher, got to about $500,000 a year positive cash flow. I realized money doesn't make me happy. I like buying assets, bought a lot of land holdings, which made my portfolio come back from a cash flow perspective. And now I've bought a lot of things that are positive cash flow, and they're different sort of properties, but I'm only buying those things now due to the fact that my foundations were so strong and they can support those properties. But tonight it's not about my portfolio, it's about you guys and how you can build your portfolio in the current market. Most of my investors, have their own story as to why they're investing. I've got an office manager here. Her name's Linda. She got to about 20 properties on a basic income with her and her husband and 2 children. She wanted to have a nice house to live in. Throughout the process, she's been able to buy, I call it a castle, here in the Hills District of Sydney, which is her dream home with her family. Her next goal is to retire in 5 years and move to Queensland. We're working towards getting those goals, and she's done really, really well. Linda's got family, so family was important for her. Looking at other people in the community. I've got a mate, Daniel, who loves to travel, and he bought his first property at the age of 28, and now he just travels and enjoys life, and not traveling too much now because of all the things going on out there in the world, but he's got the freedom to be able to do so. Lots of other investors that have got sort of 10, 15, 20 properties in their portfolio kept that portfolio to live life on their terms. So, some people, I was on the phone yesterday with someone having a map session. They want to do charitable goods for their community. Whatever your goal is your goal, but how do we get there? That's what we're here to talk about today. Before we get started, and I'll show you just real basic stuff. Feel free to ask any questions throughout the evening as well, and I will answer them either through tonight's presentation or I'll keep it to the end. But we're in 2021. 2020, there was a lot of volatility out there. People were scared. A lot of people lost their jobs. And I think it was more evident last year that you need more than one source of income in your position, right? You can earn 50 grand, 100 grand a year in your job, but just like that, you could lose your job, and all those mornings of waking up at 7 and getting home at 7 doesn't really pay off. So a lot of people looking at how can they build an alternative sort of income source, and 2020 sort of allowed for that. But most importantly, some big solid changes that occurred in the financial markets. And I'm going to start with 2001, 2011, and 2021 because they were fundamental times, and it's just interesting that they're every sort of 10 years. So in 2001, what did the property market look like? Let's just look at Sydney market. 2001, interest rates were quite high. We had just introduced the GST, and we were coming off the dot-com bubble. So there was a bubble that had burst in 1999, 2000. The dot-com bubble, which a lot of you may be familiar with. I know a lot of you guys in the community are young as well, so you may have only just been born, or if not born at that point. So in 2001, interest rates were high, property prices were cheap, and there wasn't even anyone out there in the market talking about building a property portfolio like we do today. So it was a very different environment. That's when I got excited, and I was like, wow, I could use properties as like building blocks to get a lifestyle by design rather than a life of having to get stuck in a job. In 2011, the market was a bit different. We had just seen the GFC, so in 2008, 2009, we saw the GFC come through, global financial crisis. A lot of people lost their jobs, a lot of places went bankrupt. It was a big financial mess. Looking at the market at the time, so 2001, interest rates were cheap, but interest rates were high and the prices were cheap. In 2011, interest rates were coming down and the prices were starting to rise. So as we see interest rates lower, the property prices are rising. So as we're coming out of the GFC, we saw interest rates at the RBA at 725 basis points, or 7.25 at the RBA, and they went all the way down to 3%, so 300 basis points. It's about a 60% drop, just over 60% drop of interest rates in a period of 5 months, just before the 2011 property boom. And the boom actually started in about 2010 and then took off. And in 2021, we have cheap interest rates and expensive property. So the lower the interest rates are going, the higher that the property prices are going. All the fundamentals are off the table completely. A lot of people sometimes look at me weird when I say that it's not the property that goes up in value, it's the cost of the money that is going down in value, and it's just natural inflation. Unfortunately, today I had to go to McDonald's. I was starving and I needed a bite to eat. And when I went to McDonald's, I was looking at the menu. I just ordered a little hamburger just to hit the spot, and I used to always eat at McDonald's, and the prices at McDonald's today are much higher, right? If you look at food, groceries, petrol, everything, or not petrol so much, but everything else is rising in value. So we've got more money sloshing around in the economy, and I think that we're about to see one of the mother of all booms out there. And every time they say that there's going to be a big bust, there's going to be a big boom, the media will talk about things, way off track. Everyone was saying interest rates were going to go up 3 or 4 years ago. Interest rates haven't gone up since 2010. Interest rates can't go up because if interest rates went up, then everyone would go bankrupt. We're currently at 10 basis points, 0.1% of an interest rate at the RBA. A lot of people are out there getting fixed interest rates at 1.99% and 2.2 and 2.3. That was very different. You would, in 2001, you're looking at like 8%. They went all the way up to nearly 10% around just pre-GFC, and that's when the market was crashing. So the market was crashing, interest rates rising. Interest rates go down, market rising. Here we are today, where interest rates are completely off the table. It almost costs nothing to hold that debt. And I actually had the thought recently, if you were to earn $1 million, and just think about this from two perspectives, right? If you've got $1 million worth of debt on your mortgage or whatever, everyone wants to pay down their debt. We've got inflation coming through and pushing the price of everything up now. But if you had $1 million, you could pay off your home loan and save maybe 2 or 3% in interest rate. But at the same time, that is just the end of the story. If you had that same $1 million, you could go and purchase $1 million worth of property with a 7 or 10% return and get yourself 70 to 100 grand a year income coming through from that, which will most likely rise as well in value because the rents will rise. You could take that income, that 70, 100 grand, pay whatever expenses it costs to hold it, and then service that debt of 20 or 30 grand a year in interest and have some money left over. The most important part by that is that now you've got an extra $1 million worth of asset, which will be getting inflated in value as well. So one last thing that I want to say on this slide is that I'm not a financial advisor either, and just be mindful that I'll talk about some crazy stuff here, but always don't take it as financial advice. Everybody's position is different. If you need help, reach out to myself and my team, and we can help you build a strategy in line with your goals. But looking at where we're at, the big difference between 2001, 2011, 2021 is that every time rates went lower, government incentives and stimulus packages came out, the property prices went off in a new direction. So 2001, we saw the introduction of first home at a grand, we saw the relaxed lending standards, and we saw lower interest rates coming off the dot-com bust. So we saw a bust, we saw a lot of stimulus package, we saw a boom. A few years later, we started to see contraction in the money supply, them taking away some of these packages, pushing the interest rates up, the cost of everything went up, and then the value of the property went down because it was deflationary to the amount of money that was flowing around out there. 2011, we saw money printing happen. We saw interest rates go lower, prices rose, coming off the back of the GFC. Here we are in 2021, coming off a financial depression, right? And we're in a depression. We haven't seen the full ramification of this depression because it's going to be highly inflationary as the depression. And we've got prices of everything rising, property prices rising in great leaps and bounds, and a big boom ahead. So just a few things to bear in mind. Building a strategy, I'm going to touch just briefly on this. When building a portfolio, I think it's important, people just go and focus too much on the property, where I believe instead of looking at the property, we should be looking at what is the property going to do. So understanding what are your goals. So am I trying to replace a 50 grand income? Do I have a 100 grand income goal? And then sort of working backwards to how many properties you need in order to get there. So having a strategy, having a roadmap, having an understanding of why you're buying a certain asset gives you clarity and can help you, build that, get to that position much quicker. There's always going to be hurdles along the way. Probably the biggest hurdles that I see for people is, finance. Without having money, you can't do a deal. So I'm going to touch on that on the next slide. But a part of the strategy should be, growth, acquisition. Should be, identifying, not looking too deep into it, but just understanding, how's the debt going to work, having an understanding of how tax is going to impact you, and working out, if I need to get 50 grand a year, how many properties do I require? If I want 100 grand a year, how many properties do I require? And 1 or 2 properties is not going to make you wealthy. Compared to some of your mates that you went to school with or whatever, you may be wealthy, but it's not going to retire you or replace your income. So you need a multiple property portfolio. Generally, if you want to get 50 grand a year, you probably need 3 or 4 properties owned outright, returning $300 a week. If you want to get 100 grand a year, you probably need to have about 7 properties owned outright to get yourself 100 grand a year income. Obviously, the more income you want, the more properties you require. You need to have an accumulation phase. You need to have a strategy for reducing that debt at some point and retiring that position. So, So, looking at this one, I just thought I would throw this in here for a little bit of fun. Whilst the property prices may be rising, property in a lot of instances has become cheaper. And I will explain as to what I'm looking for when I'm purchasing assets, specifically in the current market. I want to buy properties that are cheaper than what people paid for in the past. I want to buy suppressed markets because I'm thinking if there's some idiot that paid $300,000 for a property 5 years ago and I can pick it up for $150,000 and pick it up half price, then all I've got to do is wait for that person to come back and pay more money. But the difference is that I'm holding it for a cheaper cost today. The reason why, in a lot of instances, the property has become cheaper. The purchase price may have gone up, it may have gone sideways, or it may have gone down. Let's assume that a property 5 years ago was 150 grand or 200 grand, and now it's 150 or 200 grand. The difference is that owning that property today at a 3% interest rate, let's say it's 150,000 purchase price, it cost you 3% interest rate. 3% of 150,000 would be 4,500 per year. So to own a 150 grand property without any rent, without any other expenses, the mortgage would cost 4.5 grand a year. If you were to purchase this property, 5 years ago, and there's some markets which, would have sold for 200 that you can pick up for 150 today. If you were picking up a property for 200,000 going back, 5 years ago, which is now 150, you're getting a little bit cheaper, and it's right before a boom. But if you're looking at that same 200 grand property, you were paying a 7% interest rate. 7% of 200 grand is $14,000 a year. So to hold the property at 150 grand and a 3% interest rate on that would be 4.5 grand a year. To own a 200 grand property 5 years ago could have been the same thing at 7% would be 14 grand a year. So in essence, you can see the cost of holding an ownership is much cheaper. If that property for 150 grand rents for 250 a week, 250 a week times 52 would be $13,000. $13,000 minus the 4.5 grand for interest would be 8,500 per year. You've got other sort of auxiliary costs, but there is a profit there, so there is a positive cash flow component. So in a lot of instances, we've got to look at if you were in, like I'm in the Hills District, my office is here in Bella Vista. If we were to look at, say, Kellyville, going back 5 years ago or any time in the last 5 years, interest rate, say 5%, purchase price or price of it $1 million, that family's home at $1 million and a 5% interest rate would be $50,000 a year in interest. That property, for it to go up and double, it can't double because the income wouldn't support it. However, what has occurred is those families are now paying 2.5% interest rate. So to hold that same $1 million property is only $25,000 a year. what that means is that if the property goes up to $2 million now, the same cost of holding ownership of $50,000 a year would be able to hold that. So as the interest rates are coming down, it's becoming more affordable for people to buy, and as human psyche and mindset goes behind it, people will go, okay, how much can I borrow? You can borrow $800,000. Great, I'll go buy a $900,000 property. It's silly. You don't hear too many people say, how much can I borrow? You can borrow $700,000. Great, I'm going to buy a 200 grand property. I'm going to buy 10 of them. So having that debt strategy is really important. Understanding how things work. Someone just messaged, do I have massive hands? A lot of people think that I'm short because I've got no neck. I'm actually really tall. My hands are the size of dinner plates. I'm a pretty big sort of guy. So yeah, my hands probably are big, and the camera might be, on that front where it's sitting as well. So apologies for that, guys. So I wanted to pull up this slide. So when I was looking at, what I was talking about in my presentations a few years ago, I was like, I remember building a portfolio as this little squiggly thing. You can probably see the slides are different because our branding changed maybe like 3 years ago. And when it changed, this is the old branding, I just thought I would import the slide so we can see that the same things that we're looking at today, the same things we've talked about for the last 10 years, 15 years, 20 years when buying property. So an example portfolio back in 2011, when I was talking to my investors, there's a lot of people in 2011 that were scared. Back in the time of 2011, I was telling people, Mount Druitt was great. I made my first $1 million in Western Sydney. For the record, I didn't grow up in Mount Druitt. I bought my first properties out there. The media likes to tell everyone I grew up there, but I didn't. But I bought my properties out there, and everyone was like, I'm not buying in Western Sydney. It's hell. It's not good. I'm going to get bashed. I'm going to get rolled. Properties out there will never go up. It's dodgy. There was lots of opinions. A lot of people in 2011 took that leap of faith, did some cool stuff. A lot of people still probably, doing nothing 10 years on, may even be watching this video, may not be watching the video. So, you can have regrets and go, I wish I'd have bought back in 2011, but it's not 2011. We're in 2021. There's opportunities. The same strategies apply. Maybe the locations will be slightly different. The properties might be slightly different, but here we go. So a basic, this is just this little slide. Purchase a property for $200,000 with a view of going up to $400,000 in year 10. So this actually happened. This is really what happened to all of my investors that bought back in the day when I was buying out of Western Sydney. So if you bought one property and it doubled and went from 200 to 400,000, always want to remove risk from the equation. Always want to remove risk from the deal. I want it to be low risk, and that's why I've always talked about below market value, upside for growth, and strong cash flow. So if you can buy a property for these numbers are still achievable in 2021. I will show you guys very shortly some example portfolios. I have pulled out a few of my investors' portfolios from last year. I hope they're okay. No names, no details, no specifics, but I'm going to talk about their portfolios very specifically very shortly. So 200,000 purchase price, 400 grand in 10 years time. That just means it's doubled in 10 years. We can see that properties have doubled. Properties continue to double. So looking at the questions coming through, can you do this on a 40 grand income, single owned townhouse? When I first started investing, bought the first property out in Western Sydney, interest rates were sort of 7%. 250 grand purchase, rent for $180 per week. The numbers were way off, but I still was able to get a loan. It's how I structured. I realized that I couldn't go and get the dream home, so I went out and bought investment properties that would pay for themselves and have their own heart, lungs, and respiratory system. So looking at it, if you could buy a property that's 200 grand, Very simple. 200 grand goes to 400 grand, 200 grand gain, $300 a week rent. That'd be a cool outcome. There's a few equations that aren't in here. If you had 10 of these properties, it would be 10 properties at 200 grand, which would be $2 million worth of property purchased. If those properties, 10 of them went up from 400 grand, from 200 grand to 400 grand, it would be $4 million worth of property, and it would be a $2 million gain and a $3,000 per week rent. So imagine if you had to purchase 10 of these properties for 200 grand a piece back in 2011, they're now worth $400,000 in 2021. You had a 200 grand gain each one, which transpired into buying, as per the bottom on the slide here, you've got a $2 million gain. If you're sitting here in 2021, $2 million doesn't buy you all that much in 2021. However, you know, having such a little amount of debt attached to the property, this rent would have increased. So you could have the option now, if you had bought 10 of them, you could sell off 5 of these properties at 400 grand a piece, which would be $2 million. Take that $2 million, pay out the other 5 properties. You've got 5 properties unencumbered. 5 properties renting for $300 a week would be $1,500 a week, or 75 grand a year. But why would you want to sell off your properties in 2021 when an interest rate is only 2 or 3%? You'd probably just rather collect the cash flow, not paying any taxes, and continue to see these properties go from 400,000 to 800,000 over the next couple of years. So that's just a little bit on that. Understanding that if you had 10 of these $200,000 purchases in your portfolio, and they were renting for $300 per week, if the rent had just gone up by a measly $10 per week, you know, for the last 10 years. So this year the rent goes from 300 to 310. Next year the rent goes from 310 to 320, 320 to 330, so on and so forth. That means in year 10, the rent would have been $100 per week positive cash flow. So if you had $100 per week and 10 properties, that's $52,000 per year. This is literally a slide that just got taken from another slide deck and dumped in here. So yeah, looking at the equation, if you had 10 properties, the interest rates have gone down. You would have saved $100 per week in interest over the last 10 years, and you would have had a spread of you know, $100 per week increase in the cash flow. That $200 per week times 10 properties could look like, you know, $2 grand per week or 100 grand a year without selling off any of the assets. So understand that we are in a high inflation environment. We're going to see a lot more money printing in 2021, as we have seen over the course of the last decade, the previous decade before that, and basically they are printing so much money, our dollar is becoming worthless. So debt remains the same, and it becomes irrelevant with inflation. And I love looking through old stats to see if properties have gone up or down. And you know, when I buy properties cheaper than what someone did 10 years ago, I'm excited. When I see a property that's 10 times more than what it was, I'm excited. So yeah, it's finding those right opportunities in the middle that are in line with your goals. Yeah, getting into the fun stuff. So what can you do with no money? So there's 2 parts of what you will need. You will need either equity, or you need either cash as a deposit. You need a deposit. Let's call it capital. We need capital for a deposit. We need cash flow for servicing at the bank. I don't like buying properties cash outright because I think it's a poor use of capital. You can leverage those assets and have a larger asset base. So if we go back to that last slide and assume that you've got 10 properties at 200 grand a piece, that'll double to 4 million. You could either pay down that debt, or you could have had $4 million worth of property that could have doubled and gone to $8 million. So the larger the asset base, the larger it's going to multiply. And that's what I'm really excited about in the current market. You know, I'm sitting there with some people, a lot of debt. I've got probably more debt than any, you know, average sort of person in the country. I think I've got more debt than anyone personally in the country, apart from a corporation with $18 million worth of debt. That's why I need to know how debt works and how money works. You know, looking at the amount of asset that I'm holding of, say, $80 million, in the next property market, that doubles from $80 million into $160 million. then it's starting to really snowball. So if I'd have sold off, paid out the 20 mil, 18 mil worth of debt, my asset base would have shrunk and I wouldn't have capitalized on the inflation. So yeah, looking at, the fact that you need capital and you need servicing to get the loan, what can you do with $0? So, if you've got no assets, no nothing, it's much harder, right? So you're going to need cash to get into a deal. I'm going to use an example of someone here, and I hope they're okay with me sharing some properties, because those properties that I'm putting up are just, for education purpose for everybody to share around. Got a dry throat. Someone just wrote, when will I stop? I heard that you had 220 properties on the Firebug podcast. I just bought 7 motels in the first month of 2021. So those motels have all different amounts of units and different parts with them, but I just call them 7 motels. I'm going to grow my hotel brand and also take it into organic food and health food in those places. They're very blue collar, bottom end, budget chain sort of motels, but just one of the things that I'm expanding into at the moment. So for me nowadays, it's more of a game. I could just stop and I could be happy, but I find pushing the boundaries is fun. So yeah. So what can you do with $0? You could borrow it from someone. I've seen him Birch his motor, and it's actually, I will share with you guys the naming and the branding. It'll probably come out in the next 2 months because I've got a big settlement occurring for one of these properties. But I just need to get all my social media handles and all that sort of stuff finalized. So I will share that with you later. It's not Birch's motor in there. So you can borrow the money, I guess. You could set up a budget and save to get the deposit. You could possibly get a private loan from somewhere. You could sell a car. One thing that I forgot to put into this presentation was, I actually remember once I was up to property number 7 or 8. It was a property out in Western Sydney. It was in Tregear. It was a little old. It was a little 2-bedroom or 3-bedroom villa. It was only about 3-4 years old. It was an old one, but they'd renovated. It was like brand new. The whole complex had been redone. And I bought this in like about half or a third of what the owner paid. It sold previously like 300 grand. It was never worth that. I bought it for like 130. And I remember, I was like 18 or 19. I used to drink alcohol every now and then. And I remember I had a bit of a hangover. I didn't know what a hangover was. I was like, yeah, I'm buying. I'm like, how am I going to pay for the deposit when it comes to settlement? And, I had some ideas, but I was more excited at that point. James, hopefully everything's okay and your child's okay. Someone had to leave. Hopefully kid's good. If you want to access this later, there will be a recording, maybe get emailed to you. If you don't get it, speak to the team, and they'll send it over to you, a link for it. But I remember sitting there going, okay, what am I going to do? And I had a brand new Subaru Impreza. It was like a WRX thing. And what I did with the Subaru is I went and sold it a week after I bought this property, and I drove a $200 ute. I was prepared to drive the $200 ute, just simply due to the fact that it was, a part of the journey. I was happy to get rid of the car. I was happy to make the sacrifice. And since then, I went on and bought, yes, it's fitted it up now, WRX, seeing comments coming through. I went on and purchased like Bentleys and, R35 GTRs and other cool cars. Since that, and nowadays I just drive a humble truck. I'm not too excited by cars because they just don't give me too much fulfillment. But yeah, sometimes you could offload an asset. But most people out there that do have an asset, say if you bought a property 2 years ago, 3 years ago, 5 years ago, 10 years ago, if you went out and purchased a property back then, you could have seeing some growth in that property. So a lot of people have equity in their home. A lot of people don't realise that they're actually sitting on the deposit in their own home watching this video. So you could be one of the people that might go, I've got $5,000 or 10 grand savings. How could I ever get into a property? It doesn't take a lot of money to get into a property, and I will share that with you guys shortly with these next slides. And I'll try and get through them quickly because there's lots of them here. But you could be sitting on a property and have 100 grand equity in your home, be able to pull that equity out. You could either go out and earn it. Let's say that you've got $100,000 income, right? How long would it take you to save 100 grand? It might take you a month, a year, 2 years, 5 years. Everybody's position is different. Most people to save up 100 grand would take 2 to 3 years to put together that sort of money as a family income. So yeah, looking at it, if you were to save up 100 grand, you'd have to pay tax of maybe 30%. You'd probably lose 30% of that money in tax, so you might end up with 70. You save for 3 years, get 70 grand in your bank account, and you go, okay, what do I do with my 70 grand? At the same time, you could go and purchase, use the equity out of your home, let's call it. $100,000 worth of equity would cost you at 3% interest rate, $3,000 per year. So it doesn't really cost you anything in the view of having to save that $100,000. Money is worthless nowadays, and that's a big difference, and that's a big benefit of 2021, and why I believe we're going to go into a thing called a hyperinflation, which I'm not going to go into too much detail tonight, but we're going to see massive inflation and all asset prices rising because there will be a lot of people making wealth from manipulation of the currency out there. So as an example, let's assume that if I'm going to show you a scenario, a real life scenario of how someone just came on board last month or 2 months ago actually, and two months ago, and bought 4 properties and literally had less than $5,000 in their bank account, and yeah, was able to use their existing property. They only thought they'd only be able to pull out about 40 grand equity or 30 grand equity. We ended up pulling out 200,000 in equity. So keep posted for that. This one here, let's assume that we buy a property for 200,000. Like, let's assume that we're using the example that I had from way back in 2011. We buy the property number 1 for $200,000, and we're buying it below market value, and it's worth 250. So 200 grand purchase, worth 250. You'd need a $40,000 deposit for that property. So 200 purchase, 20% deposit's 40 grand, 80% loan is 160 grand. So we've got 160 grand, 40 grand deposit, need about $10,000 for stamp duty because the government loves to extort us. And this is the thing that I think we're going to see another stimulus package going. So 2001, interest rates started to come down. We saw first homeowner grants introduced, so you were getting paid to buy a property. And now they're talking about removing stamp duty and making it a regular property tax attached to the property. So that means that you would need $50,000. If you were able to, get $50,000 from somewhere, whether it comes from equity or borrowing it from somewhere else, or selling a vehicle or something like that, that $50,000 you could use in this example. So what you would do is go back and revalue the property for the $250,000. Daniel just wrote in here, how did you calculate the value of the property? You want to know when you're buying the property that it's below market value by doing research, understanding that recent sales and other properties currently on the market for sale, understanding what, if you took all the properties that were under contract out of the market, what would be the next cheapest as well, and see the trajectory of how the bank would view it. So I've been a part of over 10,000 real estate transactions. I see properties from end to end. I understand how banks work intimately, all banks. I have a finance company where I've helped over $1 billion worth of financing from that, and they're micro loans as well, like these sort of loans. And those understanding how the each scenario works will take a great interest in it, because then we can see similarities and how we can build these portfolios. So, when I talk about these revaluation numbers, and I will talk about actual valuations, I don't value a property. These are all bank valuations on any examples that I'll talk about tonight. With the question about the 20% deposit, why I always use 20% deposit is because when you use a 10% deposit, the banks don't look at it favourably. So, for example, you go to get a loan, you put down a 20% deposit, you and the bank agree, you come to the bank, they look at your situation, they say yes or no, the loan's approved. If you go for a loan that's higher than 80% loan to value ratio, the bank will then call in the mortgage insurance company, and they will come in and then they will put extra terms and conditions on it. And generally, they will say, no, we won't lend to you based on this, we won't lend to you based on that, we won't cover you, we don't like the property security, we'll only take it based on this. So, yeah, I'd prefer to keep it without the mortgage insurance. I'm okay to pay the mortgage insurance fee, it was never an issue. Certainly in the early days, I used a lot of mortgage insurance. If I went and did it again and I understood how equity worked, I wouldn't have used the mortgage insurance. I would have structured my finance better at the start. So, yes, if you had to tune out of this, there will be a link available. So, Ethan, yeah, the team will be in touch with that. Does that matter so much for medicals where the banks are happy with 15%? If you're in medical, accountancy, or legal, if you're one of the professionals that everyone says go become a doctor, a lawyer, or an accountant, the banks will actually lend you a 10% no mortgage insurance. That generally is perfectly fine because they don't require the mortgage insurance company to come to the table. So if you were to revalue the property at $250,000, you have put in $50,000 worth of your own money. You would have a $160,000 loan, and you would have $90,000 worth of equity here. So the $250,000 will be made up of a large equity component and a smaller loan component. You could go back to the bank and raise this to an 80% loan. So if you went back and got the 20% of the 250 grand out, so you would have you'd have a 250 grand property with a loan of 160. The bank would allow you to raise that up to be a $200,000 loan with a $50,000 equity. So that would look something like this. I don't know why it says here $40,000. Yeah, so you'd refinance it at 80% with a new valuation of 250. You'd have a $200,000 loan. You would have $40,000 loan withdrawal. So the difference between that is the $160,000 to the $200,000 loan that you would now have would mean that you've got a $40,000 access to the equity. From that extra $40,000, you could go and repeat the process, use that $40,000 deposit as a 20% deposit like we did here in step one, get a loan of $160,000. You would have $10,000 worth of closing costs roughly, which mean that you would require $50,000 to close it like we did to start off, but you would have $40,000 of that provided via equity. So hopefully that makes sense with you guys. This investor went out and purchased some properties using equity. So this investor thought they had 40 grand equity, there was 200 equity in there, we're able to pull out and buy 4 properties. So this is property number 1, $125,000 in New South Wales. That rent is too low. Other properties that we manage in the area, yeah, someone just said they can't see the slides. If you can't see the slides, my apologies. I don't know what's going on there. This property here should be leased for around $200 to $250 per week. So the rent is very low. The purchase price was $125. The property is probably worth about $180,000. So we pull the equity out of this one to go again. If we look at this one here, the owner of this property paid $280,000. So this property is not a crappy property. It's in a good growth corridor. It's probably about 5 years old, sold for whatever it was before, and I think it was 280 or 300,000 that they paid previously. It hasn't settled, so we haven't been able to pull the equity out yet. There's nothing really under $250,000 in the area. Rents are $330 per week. So on a cash flow perspective, as positive cash flow, it's modern with depreciation, and some poor bugger had paid sort of, 80 grand, 100 grand more. Yeah, so apparently someone said if you're watching this on a mobile, you need to swipe left if it's on a mobile. So I don't know if it's, it sounds like we're talking about Tinder. Yeah, swipe left. But yeah, apparently that might change something. You have to slide the screen across to the right to see it, to see the slide if you're going to look at it on the computer. Swipe right, somewhere right, swipe right. So yeah, check that out. So if you can't see it, I've got some techies here, which is great. So thanks for the input, guys. This is a third property that this investor bought. This property here, you can see it's on a tilt slab sort of construction, 3-story, 2-story walk-up complex. This property here, there's nothing rented in this complex or in this area available for under 320 per week. So when we're buying them, the rents are very low. We go in there and push the rents up. The agents are selling the properties to us because they don't know what they're selling. This was not on the market. There's nothing under around the 170, 180 grand in this suburb at the moment. It's modern with a lot of tax deductions and depreciation. And I believe some poor bastard paid over $200,000 for this property. So, yeah. This one here hasn't settled. It's settling shortly. Purchase price was $59,000 for a property. Rents for $140 per week. I was recently in this suburb in Queensland over the last couple of weeks. The thing I liked about this area is that there was a lot of vehicles with there were utes, white Toyotas generally, with lots of high-vis on them. There's a lot of mining happening in this area, and I think there's a lot of demand in this suburb. It's not a mining town, it's actually a coastal town, and yeah, it's very cheap, 59 grand. I just paid 74,000 for the Ford Raptor ute, and it's just the Ford Ranger Raptor, right? Who would have thought you'd buy a Ford ute, you're buying a unit cheaper. So yeah, I might take a little break and answer and look at a couple of your questions, so then we don't have heaps of questions right at the end. So is the reason why you as an individual have so much buying power because of all the companies you own? I actually can't get loans at the moment, so the banks don't service any of my money, so I don't fit their equations anymore. So I do buy a lot of properties cash nowadays. I invest into many different things, whether it be cryptocurrencies, properties, I have solar farms, I have lots of different other interests. I get cash flow coming through, and as soon as I get that cash flow, before I've got it, I've already spent it on more assets that are being inflated. So I'm just constantly increasing my base. Hey Nathan, it's Jez here. Thanks for getting us our first investment. Just got our approval. We're excited to see where it takes us moving forward. Thanks again. Awesome stuff. Jess, I actually went through you and Adrian's report today, gave some notes to the team, personally had a look at that. So congrats on your first property. Can you include the B.Invested fee in the calculations to show how to best manage that in the equation? I haven't got it because this is all sort of put together to start off with. But you know, for a lot of people like that don't realise or may know, I run an investment firm here, obviously B.Invested. I was Australia's probably 3rd or 4th buyer's agent ever to exist. Operate very different to any other buyer's agency in the country. I actually do all the locating and negotiation of the deals myself, and I purchase all of these properties. I've been to a lot of them, not all of them. They are, 7,000 k's apart, some of them, so maybe even 9,000 k's apart, because we go coast to coast of the country. I do drive out to all the locations and do look at what we are buying, but I don't look specifically inside every one. However, I negotiate properties, locate the deals, structure the portfolios for my investors, make the recommendations of buying, and do all of that myself. So I charge a fee. I didn't get paid by a developer or for someone to sell something to anyone, so I do charge a fee. If you guys are interested in that, just reach out and have a chat with my team. I need a strategy to start investing with small deposit. Reckon we need to catch up. It's been about a year, so let's have a chat. If you can message the team, whoever your investor relation manager is at the moment, and I'll organise a chat for us to have a talk. What is your thoughts on buying for capital growth primarily? Example, buying properties closer to the CBD. Obviously, properties cost more. Would you prefer cheap property with cash flow to service debt? Good question. It depends where you're at in your portfolio and what you require. Do you require cash flow? Do you require equity? Half of my portfolio is not property that I initially would have purchased, but the properties I bought because I knew it would make the banks happy to lend me more money. So do we need cash flow to keep going? Do we need equity? You will see some trends of different things. I've got some properties here which are in city centres for like 750 grand and stuff like that. So these portfolios are just some examples. They have all different purchase prices in all different places, but a lot of these properties that I'm sharing are actually in capital cities, so they're not in regional towns. Like the $59,000 one, obviously it was in a regional town, but it was a very large regional hub. But the ones for 150 and 200, they are actually in city centres, like big major cities. Hi Nathan, do the last 4 property purchases you showed have any upside for capital growth, or they're recommended for cash flow? They are all growth properties. So those properties, when we buy them, have equity. I'm going to show you a lot more of these examples, so just bear with me with this, because I've got like 50 slides of these different properties and different scenarios and how they've helped someone go from one to the other. So I think you're going to be really excited by seeing that when I get to them. How do you manage property expenses without drowning in bills? I want to make sure that the properties, when I'm securing them, are neutral to positive cash flow, so the rent will cover all of the expenses that it costs to hold the property. Do you do many renovations to build in more equity before refinancing? No, I prefer to do no renovations. If I don't have to do a reno, the better, because it takes your time, slows you down, and you can't build it quick enough. You spend 50 grand into a reno, you can spend 50 grand in the next deposit. Renovating all these properties is going to tie up all your capital, and you're not going to be able to move quickly. What do you believe is the most reasonable interest rate for investment loans at the moment? The banks seem to be pushing fixed rates. Also, should you just keep as variable at the moment based on the RBA not increasing rates? So fingers crossed for the next 3 years. None of my properties I am fixed on at the moment. I personally feel the interest rates will be heading lower. Think about it. If the banks are offering fixed rates for 1% cheaper, then it's obviously a sign that the interest rates will most likely go down. So do I still avoid regional towns like the plague? I've always bought in them, but I don't just go to regional towns. People think that when I talk about these low price properties that they must be in a regional town. They are not necessarily, in regional towns. 9 times out of 10 are in capital cities, but I will buy in regional towns if the numbers stack up. Hi Nathan, do these lower price properties need renos before they go to rent? No. I haven't purchased my first investment property yet. What is some advice you can give if it's better to invest in multiple store properties for the value up to 700 grand, or buy my first home at only 700 grand? I'm going to answer that question. I'm going to get straight on the next slide, so I don't bore everyone. I'm going to take little breaks to answer some of your questions. So keep them coming through in the meanwhile. So should you buy a 700 grand property or buy investment properties? Whether they're smaller or not, I don't know your position, so I can't give you advice. I could say, yes, the 700 grand one could be good, or it could be that you buy 350 grand properties. There is variables, right? The difference between whether you're buying a house to live in, or a house or a unit or a townhouse to invest into, the difference is if you're buying that property to live in, you're on the hook to pay that mortgage. So you are on the hook for the debt. You have to, if you don't have a job, that property ain't getting paid for. With these investment properties, if you don't have a job, that's great, right? The tenants are paying the rent, the mortgage is getting paid themselves, and there might be a bit of leftover money to go into your pocket so you can survive buy a pack of smokes or whatever you want to spend your rental income on. So yeah, so there is variables. Depends where you're at in life, what you're looking for, and what works best for you. So if you'd like help in that front, reach out to my team, admin@binvested.com.au. Call us on 1300 367 925. I'm going to move on to the next slide. I'm going to keep a little note there for next time we take a break. What could you do with $30,000? $30,000 doesn't buy much in today's market. I'm going to share with you. It's a small step for someone, but it's a big deal. This. So here we are with a property. I'm going to share with you a really cool scenario, something that happened late in 2020, like probably about 2 months ago. So if I had someone come to us with $30,000, this is a real example. I've got a real example after it to show you, exactly what happened here. So if you had $30,000, you could buy a property for $100,000. So then you're into the market. If you buy that property that's worth $130,000, you pick it up for $100,000. You lay down a $20,000 deposit. Go to the bank, pick up an $80,000 loan, $10,000 worth of closing costs, meaning that you would need $30,000 worth of capital, being the deposit. So that could come from equity, could come from savings, could come from selling your car, could be from wherever. Step 2, revalue the property from $130,000. So if you revalue the property from $130,000 to $130,000, that would mean that you've got an $80,000 loan, and you would have $50,000 equity in there. So looking at it, pulling out 20% of that $130,000 would mean that the difference between $130,000, 80% of that would now be $106,000. Meaning that the difference between $106,000 and $130,000 would be $24,000 that you could withdraw from equity. You refinance that. Oh, here we go. It's down here. I was calculating that in my head. Refinancing at 80% LVR for a new valuation of $130,000 equals $104,000 loan. Repeat the process. $20,000 deposit down, $80,000 loan, $10,000 closing cost, $30,000 required. $24,000 of it provided via equity to go on to your next deal. So, as I have some more water, people always think I'm drinking vodka. I don't know why. I don't drink. But looking at this investor here, had an investor that came to us with about $28,000, $30,000, something like that. It was under 30, and we bought him a property here. Purchase price was $74,000. There is now nothing under $150 in this suburb. It's revalued for $130. Could be $128, $132. I know that he pulled out about $45,000 worth of equity from this property, and then we're able to take that equity. So if we look at the property, 74 grand, rents for 220 bucks a week. The rent covers the mortgage. The mortgage on 74 grand would have been like let's just assume he pulled all his equity out, right? Let's say he's got a loan of 74 grand now. Let's say he's got a loan of 100 grand at 3%. That's 3 grand a year in interest. That's 60 bucks a week. If you're getting 220 bucks a week, there's money left over there. So looking at what we did afterwards, we pulled out that equity. We purchased this property for $155,000. Revalued that, which is at the moment we're in the process of organising that. The rent is very low on this, but we bought property number 2 within a month. So the person came to us with $30,000. We did this process. We pulled out much more than what we were hoping for. With that, we're able to buy property number 2, and in the process of looking at property number 3. So on that note, I'm going to answer a couple more of your questions. Keep them coming through, and I'm going to go to a next one. So Luke asked, can you share the property address for individual research? Absolutely not. I don't mean to be funny by that. That's my intellectual property. I was putting these slide decks together last night at 4 a.m., 4 a.m., sending all their data to my staff. I do 20-hour days. I've got a team of 100 people here throughout my group of companies that are here to help investors. And that's sort of intellectual property is where these properties are located and all that sort of stuff. How can you increase your portfolio if your serviceability is maxed out? Good question. These properties I look at as purely a vehicle to increase the cash flow, increase to meet the servicing. So everybody's position is different. What we specialize in here is understanding finance, understanding strategy, finding the deals, and working our way through. So I purchase property sometimes for 50 grand, as I showed you beforehand. Some people might fail by servicing. I actually had someone that failed by servicing the other day by $300 per month. He had sort of like 200 grand cash or equity that he had sitting in an offset account. We bought a property for $73,000. With that property for $73,000, it rents for $340 per week. So that's about $1,400 a month. That $1,400 is going to increase the servicing, meaning that the client can go back and pull out equity and service more investment property. So you can actually cure yourself, but a lot of people just screw themselves up and they don't have a strategy on how to get to where they want to be. So if you are stuck, reach out to my team. I've got really amazing finance team that can help investors with their portfolios. I'm seeing a lot of people asking about what interest rate they should be paying. Is 5% expensive? It is if you could get it for 2%, but it depends which bank, depends what your servicing is like. I had one of my investors, which is probably watching this tonight, last year save $50,000 per year from restructuring his debt. So if you need to restructure, let me know. I'll put you in contact with my team. So what else we've got here? Matt, it's been a while since our last chat, since the map session. I'm pulling out equity at the moment from my property, so we'll be keen to chat regarding the buyer's agency when I am ready. And I look forward to helping you and us chatting soon. If you have any questions, flick me a text. You will have my number, or reach out to the team and we can get the ball rolling. Do you do research on the towns? Example, what are the main work in that area? Any things to look out for? Yes. No matter where I'm buying, if I'm buying for my investors, I'm buying for myself as well. So yeah. Do you look after the investment property once we buy through you? Yes. So as a part of my group of companies, I have a law firm, accountancy practice, financial planning, finance company, accountancy practice, the buyer's agency, an education business, other sort of non-property related stuff. But one of the businesses is a asset management firm where I manage the properties. I don't like real estate agents managing my assets. The reason being is, a real estate agent looks at it as a property that they're incubating to sell. I see so many investors over the years which have bought a property that they might have paid 200, it might have gone up to 250 or 280. The agent says you can get 280. The person says, "Oh, I'll sell it." Next time I speak to them, like, "Where'd your properties go?" It's like, "I sold it." It's like, "Well, now you can't get the finance. Your investment is screwed. You can't go back and fix this mess up." Because the real estate agent tried to coax the person into selling the property. The rents are low, like I was showing with these when I'm buying, the rents are too low. So I do have a firm where I do manage the properties for my investors. Hi Nathan, great webinar. What is the time frame from the first step 1 to step 4 from your slide? Buy, revalue, refinance, repeat. Good question. I always suggest to people that we should wait. Whether it be 6 months, 12 months, we can't control the banks. All we can do is make sure that we're keeping the banks happy by meeting the back end of their system, keeping the banks happy by showing that you've got strong servicing, buying properties that are below market value, so you can say, "Look, this is worth more money. Can you give us a loan for it?" And acquiring the right assets. In that scenario with those properties there, where is it? In that scenario, to go from this property to this property, now to the third property, the investor probably like 3 months to get on the 3, but that's a out of the line sort of scenario. So don't yeah, hold that one to me, but normally a few months. Do I sleep at the office? No, I went home. Would you recommend buying with your super fund? Potentially, but I can't give financial advice on a super fund. I can't give you any advice on that. However, if you do need help, I've got a team of advisors. I don't like financial planners. They generally just want to sell you insurance. They want to sell you shares and manage funds, which they get a commission on. But I do have a few good financial planners that I've worked with for a long time that could talk to you about whether it's good or not for you. Are all these properties freehold or leasehold or a mixture of the two? No, they are all freehold, no leasehold properties. I've never bought a leasehold. I'm not interested in it. If you wanted to get into the market with the example of $30,000, would it be better to go with the process you explained, or would it be better to keep saving in order to take advantage of the first home and grants available? Can't answer that one because I don't want to be saying don't go buy your dream house. You've got to look at, if we're looking at the first home in the market at the moment, there is so much pushing up in certain markets. If you look at Sydney, a lot of these properties have gone up in value by $150,000, $200,000. There's developers making big commissions, all that sort of stuff, and inflated prices. So do you want to buy in a market where you're getting 20 grand or 10 grand to pay 200 grand overpriced, or do you want to build a strategy that's going to work with you to get to where you want to be? So for me, if I was a first homeowner today, I wouldn't care about the first homeowner grant personally, because I'd be looking at building a portfolio. So are you trying to pick up a few bucks and try and save, which I know it's a lot of money, but are you buying an asset that's overinflated? As I showed you guys beforehand, some of the properties people, especially the new ones, the glossy ones, the ones in the brochure, the salespeople, the suits, try and sell you, those properties have got a lot of commissions in the back end, $30,000, $40,000, $80,000 worth of commissions, and they're getting big fat checks, but they don't add up, from a valuation. So 10 years later, you're selling the property cheaper than what you paid for it. So, yeah. I'm going to get on to the next slide, and I'll come back and answer some more of your questions there. So what can you do with $100,000? I've got some scenarios here of people that have done it. And these couple of examples for the next two slides are people that have done it in 2020 and started probably around the middle of 2020. So no earlier than June last year. What can you do with 100 grand? You could use a similar example of the first one, but go and buy two properties for $200,000. So two properties at 200 grand that are worth 150,000. On each property, you would put down the $40,000 deposit, get 160 grand loan, $10,000 in closing costs, having 50 grand capital. You'll times that by two, so that would be your $100,000 in the property. You would revalue both of those properties using the example from step one. So the property value at 250,000, you'll have 90,000 in equity and 160,000 in loan. As you revalue that property at 250,000, 80% of that would be $200,000. The 160 minus 200 would leave you with the $40,000. You would have two of these properties, so we would end up back with $80,000 in that scenario. From that, repeat the process, two properties at $200,000, doing the same thing again for property number 3 and 4. So I've got a very dry throat today. So this was an example of someone in real time from July last year, June, July last year, doing it with $70,000 worth of savings. So this property here we purchased on behalf of the investor for $290,000, revalued it immediately after settlement for $340,000, and it rents for $330 per week. I personally actually own in the same complex of this, so when I say that I buy properties for my investors that I buy myself, I think my one's around here. I bought it in 2008, and I was laughed at the time because I was told that, I wouldn't make money and all that sort of stuff. I think I paid $137,000 to buy in that. And that is in Sydney. That is in a growth corridor of Sydney. They've just rezoned this for about 40-story development all around. This being in the high density area, most likely cause for developers to come back in the next sort of 5 years or so, knock all this stuff over and start building large developments. This property here was located in the Gold Coast. It looks like it's just a clothesline, but it's the photo the team have taken. Got from the ad. It's a 2-bedroom villa here. It is in the Gold Coast. As we all know, the Gold Coast is booming at the moment. We were able to get this property off market, so it wasn't listed to the public. People didn't have access to this sort of property. We bought it for $200,000, revalued it straight away for $250,000. It rents for $280 per week. Probably pushed the rent up a little bit higher, but there's $40,000 back out. There's $50,000 back out. 80% of that, sorry, would be about another $40,000. So you can see where it's gone on. This one here has not settled yet. So this investor's gone from 0 properties to 5 properties in a very short period of time. This is a 2-bedroom unit. I saw this unit the other day actually, and I did a video of it. So that video will be going up live soon. The rent you should be getting $220 per week. Nothing rents for less than $220 per week. And nothing is selling for under 150. This one here for 90,000 is in the same area, but a bit better than the one that we revalued for that guy that started with a 75,000 and pulled out for 130. So this would have to revalue for 130, maybe 140. Strong cash flow is keeping the servicing intact for this investor. Being below market value, we're being able to accumulate many more assets. So this guy's gone from 0 to 5 properties in a year. This property here, it has a nice pool. It purchased it for $55,000 off market. Comparables in this complex used to sell up to about $120,000. It got hit a few years ago. There is nothing for sale under $90,000 in the area now. And rent in this complex, I actually own in the same complex, getting $240 per week for all my investors' ones as well. This property here was in Brisbane, or it still is in Brisbane. It's in Brisbane. Purchase price is $110,000. So this property is 20 kilometres from Brisbane CBD. It hasn't settled yet. I own in the same complex as this one. I paid $124,000. This one rents for $210 per week. I get $240 for mine. So we have properties that I'm buying myself. My investors buy the same one. So this guy's gone from 0 to 5 properties in a period of about 5 or 6 months. Any horror stories with tenants, and what steps do you recommend in case those horror stories arise, insurance, etc.? Always have insurance on my properties. I actually love when something goes wrong because I'm like, I'm getting free renovation now. The insurance company is going to pay for that, etc. So yeah, like having a good property manager in place, having good, solid, strong systems, processes, and procedures would be, very, very important. I don't lose money on investing when it comes to tenants, just because I manage really, really well. So if you guys have properties and want to get a second opinion, I actually have like dozens of asset managers nationally that manage properties on behalf of investors, so I can look after that for you. Jack asked for this to be emailed to him. It might come out. If not, reach out to the team. They will send it to you. But you've already left, so you won't see me saying this. Should we be pushing real estate managers to raise the rent each year? Yes. The difference between $10 per week, if you've got 10 properties, it's $100 a week, $5 grand a year. Really, really important. Just recently in Queensland, for example, we are pushing rents on average around $50 to $80 per week in the Gold Coast and Brisbane region. So be very important to sort that out. Do you have the comparative market analysis in-house? How did you go about this in the early days? Good question. I actually do all the research and negotiating the deals myself. Over Christmas and New Year's, I put out over 100 offers. I was talking to all the agents, Boxing Day, New Year's Eve, New Year's Day, hustling deals. I did drive 7,000 kilometres, so I do a lot of the work myself. It's not a job, it's a lifestyle, so I have fun doing what I do. So I actually do that research myself. Someone asked me beforehand, is it true that I have a photographic memory? I think it was Sita. And yes, I do have, I wouldn't say it's photographic, but it's very close to it. I have a very strong memory. So with these slides, I actually pulled out the properties, said this property, this property, this property, go get the address, put them in here. So yeah, I do the research myself. So then quality control is there for my investors. Hey Nathan, so the refinancing scenario issue I have, property number 1 has approximately 170k equity, however property number 2 is negative 70 grand equity. The debt to loan swapping strategy you mentioned last year in one of your videos, is that a potential strategy for this scenario? Yes, I did do the swapping strategy where I helped someone replace the actual security swap of that loan. It is a possibility. Very important to structure your loans correctly. And this is not a video about structuring loans. It's a video about building a portfolio. From cross-collateralizing loans, I've got $1 billion worth of funds plus under management here, and those loans are not loans that have been cross-securitized together. So none of them, like 0 properties that we have funded have been crossed. So make sure your loans are set up correctly. If you need help, reach out to my team. You can email us at admin@binvested.com.au, call us on 1300 367 925, chat to one of my investor relation managers. They will put you in contact with my right professionals. If you do need help finding the properties, I actually do it with property and strategy myself. But if it's from a financing perspective or whatnot, I've got great finance guys here and girls, lots of ladies in my office, which help out and build portfolios. When would you recommend buying property under your name versus under a trust with a corporate trustee? When would you recommend buying under your name? Same question again. I've seen a lot of my investors get to these 10, 15, 20 property portfolios without ever using a trust. They do have a place, but 80% of the time people screw themselves up because it gets in the way of finance. Plus it holds them back from a tax perspective. It's not always best to put them under a trust. Make sure that you have an honest accountant, which isn't just trying to sell you a trust. A lot of accountants will try and sell you a trust, so then you do an extra set of accounts with them so they earn more money. Everyone's asking to get this presentation sent to them, which is great, but then they leave. I need you guys to, if you don't get a copy of it, it should have naturally come out to you, but if it doesn't come out to you and get emailed to you, call my team, email my team, and they will send it over to you. If we were purchasing a property through your company with a 30 grand deposit, do we actually need 50 grand to pay for your services? Good question. The fees that I charge, you can put them on a payment plan. So some of my investors might do it over a period of 12 months. They might pay off over 12 months, or they pay it using the equity that they get out from their property. So yeah, happy to talk about that, speak to the team. Marcelo, thanks Nathan, team, one of the best webinar from B.Invested. I really appreciate all the information. Cool stuff, mate. Appreciate the feedback. I hear that everybody loved my webinar on goal setting. I did a goal setting one in December. If you haven't watched that one, it actually went on for 3 hours. And yeah, so Corona, cough, cough. I don't think it, but I was just coughing. I've had aircon. I've been sleeping with aircon on and stuff, so it's been a bit like that. So yeah, I'm going to leave the questions there for the moment. I'm going to come back and look at them again shortly. I'm going to hop back into what you can do with 150 grand. I'm going to skim very quickly through this one because it's very much the same as all the other ones. I think we're getting the picture now that if we're using a $200,000 purchase price, so it doesn't mean that you need to buy a property with a $200,000 purchase price. It could be 100 grand, it could be 300 grand. As you've seen from some of these examples, some are very cheap and some are much more expensive. So this is an example of a portfolio with someone starting with $100,000, and there's a lot of art. I'd call it artwork that I put in to constructing these portfolios on behalf of my owners, because I need to know how the finance works to get them to where they want to be. So with this one here, I've got so many examples of cool stuff. There's one of the guys here, one of my investors that isn't watching today, but actually you know who you are. You texted me on WhatsApp beforehand, and asked me could I send a copy through. This investor came to me maybe 3 months ago, had a position of equity in their properties. They started with one of those positions of $0. Like literally to this day, I don't think he has put down $1 of his money. I think it's all come from equity from his existing properties. He's had like three properties in his portfolio. Neutral cash flow, not positive. He wanted to have $80,000 income to replace his salary because he had the equity, properties that I bought him, and he wanted to be aggressive with his goals. We're able to get there within 4 months. So replacing an 80 grand income in 4 months, and this is like a out of the box one, so I can't just go, okay, I'm going to, get there straight away. But this guy had equity already in the existing property. I think it was maybe like 300-400 grand in equity, and it's maybe like 50 or 100 grand in savings. However, we haven't touched that savings yet. We're going to probably touch that with the next properties. I think there was like 4 foundation properties that we bought, like 200-300 grand properties that was purchased so far for him, plus a property that was 300,000. That is $500 a week positive cash flow. So each of the foundation properties, let's call it $50 a week positive cash flow. So 4 properties at $50 a week positive cash flow is $200 a week positive, plus 1 property which was under 300 grand that was positive by $500 a week. So it's $700 a week positive cash flow. And in the latest property, which was a 620 grand property that rents for about $1,600 a week, after all expenses is positive about $800 per week. He is now on about $1,500 a week positive cash flow. So that's someone that has done it using equity. But this is a different scenario. This person's portfolio started with $100,000. This couple wanted to keep it low risk, so I think they only spent about 75 to 80 grand to build this portfolio. They're getting married, and if they're watching, hope you're doing well, guys. They purchased this first property for $136,000. It is in Perth CBD, right? It was in the city of Perth. Go find them. You can't find them. You can't find one like this. Revalued at $200,000. We paid $136,000. Revalued it for $200,000. Pulled out the equity, and we also bought this other property at the same time. So we bought this property for $150,000. We revalued it for $220,000. It is not sexy. It is not flash, but it is very fundamental. This investor was able to, between these 2 properties, pull out $100,000. So put in 80, pulled out 100. This was in a month. So those 2 properties pulled out the equity, and we're able to go and purchase some more properties. So this one here, high cash flow, $158,000. It hasn't settled yet. Rents for $265 per week. Should be able to revalue it for around $220,000 as well. So nice sort of looking property. Got some palm trees there. So we haven't pulled equity out of this one. And then we have this one here, which we bought for $241,000. There has been sales in the same complex for $339,000. So if you are watching this, you know whose property this is. You know it's your property. When it settles, which it hasn't yet, we're going to go back and try and rip out the equity. 330 is comparable sales in the complex. We don't know what it's going to value up to, so that's why I can't put a revalue figure in there, because I'm not the bank. So yeah. So that's a portfolio of someone buying 4 properties in sort of 4 or 5 months. Also planning a wedding, and we're going to be able to go buy another 2 properties very shortly, and hopefully be at 10 properties in the next sort of 12 months. So over a period of 2 years, 3 years, get to 10 properties, buying the right assets. Just got lots of questions here. Can you go back to the last slide for 1 second? Sorry, I don't know which slide that was. I've got too many of them, but you can watch this later. Who does the valuation? The bank that you have the loan with, or your finance team? I can't do a loan. I can't do a valuation. So the bank orders the valuation. So these are all bank valuations. When I've quoted that there is a valuation, it is a bank that does the valuation. So I make no, you know, guarantees on a bank revaluing a property ever. So I just want to be very clear for everybody. If you buy a property, I'm not guaranteeing you equity. I can't do that because I'm not the bank. However, yeah. So how did I get across the border? No, I wasn't in Sydney. So yeah, if you're not in Sydney, then you're allowed to cross the border. So I got into other states, which got to go back in a couple of weeks, which I think the borders are all open now, so it's not an issue either. Does the positive cash flow include strata costs as well as mortgage repayments? Yes, when I calculate costs, I want to make sure that the cost is including council rates, water rates, real estate agent fees, insurances, all of that after all expenses, before any tax deductions. So I don't include any tax deductions, because if you weren't working, you wouldn't be paying tax. So it wouldn't give a true reflection on being able to get you to your financial goals. So if it does have a tax deduction, that's just a bonus. How much of a buffer savings would you need if you unexpectedly goes to shits? For example, you lose your job or health reasons. I like buying properties below market value. So if the property market turns to shit, you can sell off the property and not be scathed. I personally have constant cash flow coming through, plus I've got other alternative financial instruments, so I don't have much of a buffer. Everyone thinks Nathan will have cash sitting there. I have cash flow, which is important, so I know that it's going to be coming through. If it's not from one property, it'll be from another. It'll be from other assets that I've got that bring in cash flow. So yeah, it depends. It's different for everybody. Sleep at night. It could be $5,000 per property. It could be $2,000. If you've got 100 properties and it's $5,000 per property, that's $500,000. Chances of that happening would be low. So yeah, what would it cost to be your sidekick for a day in the life of Nathan Birch? I have a very, very boring life. Trust me. Everyone thinks I should be on boats and yachts and doing crazy things. Oh yeah, it's not like that. I have a very streamlined and systemized and in control sort of life. So yeah, with it, I've never really thought about that, but yeah, I try to share as much as I can with everyone to see what I do and be a part of that. Nick, hi Nathan, thanks for the video. We'll be in touch. Kids bedtime. Good night, everyone. But yeah, we'll chat soon, Nick. Look forward to helping you however I can. Thank you, Nathan. Attention for the swap is to grow my portfolio. I'm stuck and need your help. Been following you for a couple of years now, and say a level of ambition and mindset has been very inspiring and an awesome role model. Appreciate that, Jake. Appreciate it. Happy to help out however I can. So if you want to reach out to the team, let us know how we can. If you say trusts aren't always the go-to, how do you asset protect? There is all different ways to protect your assets. You can put second mortgages over them and all different things like that. You can load things up with debt. You can still have your assets attacked inside of a trust. So don't think that that putting them in a trust specifically will protect you. So goal setting webinar was incredible. Thanks, Andrea. Hopefully you're enjoying this evening's ones as well. Is there really that many properties under 200,000? It doesn't seem real. Well, they're real deals. They're real deals that happen. There are deals out there. There's a difference between buying them well priced and below market value, or buying a cheap deal. So you don't want to buy something because it's cheap, because that's all it is. It's just cheap, right? You want to buy something of value. You want to buy something that it's got substance. So there's lots of, if you look on the internet, you're littered with choices of properties under 200,000 in Australia, but are they the right assets? Are they going to carry you to where you want to be on the other side? Yeah. I would like to get a link for this to share to my show with my wife later. Sure. Just if you don't get emailed after this video, send an email to my team maybe in 24, 48 hours, because it takes a while for them to edit it and send it out and upload it to wherever it goes to. So yeah, if you don't get it within 48 hours, just call my team 1300 367 925 or email the team on admin@binvested.com.au. Don't know if this question has been answered. Is it a good idea to create a business title on our properties instead of using our names for protection? We did cover that. That's like the trust. if you guys need help or you're unsure whether a trust is good or not, you know, a lot of accountants will try and sell you trusts, which isn't necessarily the best thing as advice. Reach out to my team once again via the contacts and ask to be put in contact with Ridwan. My personal accountant is a gentleman. He's a gentleman of a guy. So have a chat with him, see how he can help you and how his team can help. Jerry, I hope you're doing well, mate. I hope you're doing well. You, my friend, have been fucking killing it. Sorry if anyone's kids are watching this, but you have done really awesome things. So just a bit of a background. Me and Jerry have been talking for maybe 2 months now. We had a chat just before Christmas, finalising my loans for the 6 properties purchased since late December. So excited. So you've bought 6 properties over Christmas. One of those properties was a block of 5 units as well. So technically, if you want to look at doors and tenancies, you could subdivide and strata off and sell those 5 units separately. You've got 6 properties in blue chip locations, something like, I mean, Sydney Harbour locations and prime locations on the Gold Coast. You've also got a block of 5 units, so you've done really, really incredibly well. That's almost 10 properties in a month, right? So congrats, Jerry, and yeah, sorry for going into that, but you're doing great, so congrats, you should be proud. Does having a low income and being 50 years old go against borrowing if you have 750 in equity? No. If you're 50, you should be fine. I know people that are in their 50s that have been able to build double-digit portfolios in the last sort of 2 or 3 years. Some of them, I think, may be watching in here. So yeah, I'd suggest now, you know, if you wait another 5 years or 10 years, responsible service of lending at the banks will be really strict on you. So best to get everything structured now. And also with your debts, if you're heading into the 50s, make sure that you plan the debt to last for you to be able to carry through retirement as well. So if you need help, reach out to my team on that front. I'm going to talk about something else here, which kind of ties into that question of income and equity and whatnot. What do you need? You need to work out, as a part of building out a large property portfolio, there's a big difference between getting 1 or 2 properties and getting 10 or 20 properties in your portfolio. And a lot of it comes down to structure, the right asset accumulation, as well as getting the right finance strategy down pat. So do you need equity? Do you need cash flow for servicing? What does it require for you to put into your portfolio? So do you have cash savings? Do you need equity? You need to tick the boxes like, you know, is it cash flow positive? Is it giving you the equity? Is it giving you the growth? You know, what are you funding short on? What is your finance position like? So a lot of it, 50% of it, I can show you cool properties all day long. I specialize in properties. That's what I do. I have a big understanding of every intricate part of how a portfolio gets built, and that's what I specialize in. However, I'm not the finance person that deals with the banks every day. So when it comes to understanding finance, it's good to have a good broker that understands how to get you to where you want to be. I will talk about the importance of the team a little bit later as well. So yeah, with it, seeing a few of your questions. Keep the questions coming. Here is an example. This is someone that I'm not actually going to mention their name or anything like that, but this is someone that one of my really cool, proud stories. I showed a few cool stories from 2020 tonight, but this one here is someone that came to me last year and said, I've got 70 grand, I want to build a portfolio. And we did some really cool things. So I'm going to pull this apart to share with you specifically why I chose a specific property and what it enabled the person to do. So this property here is located in the heart of the Gold Coast. It's really nothing sexy or flash, but it's very fundamental. Purchase price was 200 grand. Revalued it 3 days after settlement. I spoke to her on the Saturday, settled on the Thursday. On the Monday, revalued it for 255. Says he rents 370 per week. I don't know about that. That seems a bit high. Whether that's an error or not, I would have thought it would have been around the 300, 320 per week, but I could be wrong. But let's assume it's only 300 bucks a week. It still meets the criteria of what we were looking at beforehand. This property here, we're able to pull out. We bought it for 200, revalued it for 255. The servicing at 300 keeps it neutral. The equity was $44,000. That there meant that you got into the deal, pulled the equity out, and be able to use that $44,000 for a further deposit. At the same time, this person bought this property, which is a townhouse. It actually looks quite nice. For 150 grand, the owner had actually paid 190. So this is funny. We bought it for 150. The owner paid 190, and we revalued it for 190 a week after settlement. So this person bought two properties at the same time using the $70,000. 150 and the other one for $200,000 meant that there was a $350,000 purchase. Equity that we pulled out is 32 and the 44, so we got back $76,000. From that, I went to Perth and I bought this property. I don't know which one it was. And we bought it for 130. Revalued the property straight away within a week of settlement for 200,000, and it rents for 200 bucks a week. There was actually a filming in here, I think from memory. I think I only saw a part of the video that there was a rental shortage in Perth City. So yeah, we're able to pull 56,000 equity out of it. So we bought the first two, and then we bought two further ones. This property here was a 3-bedroom townhouse. I think it's this one, or maybe this one, or whatever it is. Bought a 3-bedroom, maybe it's a unit. I forget what it was exactly. All I look at is the numbers. So 59,000, as I said beforehand, I bought my Ford Ranger for 74,000. It was good value. It's probably worth 82, 85, brand new. So I bought that below market value. But here we've got a 3-bedroom unit for 59 grand. I bought this one because I wanted to boost the servicing up. So there was no equity in this property, right? We haven't gone for it. It's actually getting revalued at the moment. I've requested for it to get revalued. A recent sale in the same complex. So the property at the same time came on the market for 119,000 and it sold. It rents for 250 because that's what my staff put in here because I didn't give them the updated news. So straight after settlement, I was to this investor. I said, "Your rent is too damn low." I sound like that guy on the internet. The rent is too damn high. If anyone knows that meme guy from back in 2008 or whatever. But the rent was too damn low, and there was nothing under 375. So I think the rent may have gone up to 300, 350. Whatever, because I'm already picturing a problem in the future, and that is servicing. I need to know how the banks are going to look at this so we can buy the right asset. So this property here, 59,000 purchase. We're going to reval it soon. Recent sale is that. We haven't pulled out equity, but it rents for 300 and something a week. This property used to sell. Other sales in the block sold 5 years ago for $500,000, $600,000. They used to rent for $1,500 to $1,800 per week. So to pick this property up so low, it was right at the bottom. I understand other markets besides property. I research and I invest in the commodities, all different commodities, and I know when markets are about to take off and when it's profitable to pull stuff out of the ground. So someone asked me beforehand about research and whatnot. But yeah, with it, I knew what we're buying here, and now there's nothing under 350,000 in the suburb anyway. So reason why I did that is I bought this property in Sydney. We're able to revalue it straight after settlement. Bought it for 285, revalued for 315, pulled out 24 grand, and able to buy a 6th property. So this was a 6th property. Started with 70 grand. This is a property that's only 5 years old. Purchase price was off market, 130 grand. It hasn't settled yet. Rents, I think it's rented actually for $255 per week, not $240. But yeah, there's 6 properties with someone in 2020. So I want to get this person to double-digit property portfolio in 2021. Looks like I'm going to answer some of your questions. It looks like 90% of the properties you buy are cash flow positive. I thought that was extremely hard to do nowadays. Look, they're neutral cash flow, like after all expenses. I wouldn't say they're heavily positive or anything like that, but everything's starting to become positive cash flow with such low interest rates. So yeah. How does the revaluation increase the market like that? Is this buying below market value? Are you doing any value adding? No, not doing any value adding, just buying well-priced properties. Can you please explain how the valuation changed in such a short period of time? We're just buying them cheap. Where do you find property so cheap? That's what I specialise in. Hi Nathan, sorry for hopping on so late. Will I be able to watch this again from the start? Kylie, yes, you can watch it. It will probably come out to you in about 2 days. If you haven't received it in 2 days, reach out to my team and they'll get in touch with you. What's the minimum income required to get started? Is $35,000 per annum enough? I just had someone buy property on their apprenticeship. I think they're like 18 and they're on like 25 grand. So it just depends, what your income is, what expenses you have, what commitments, are you married, do you have a spouse, do you have children that are dependents, etc. But reach out to my team, that's what we specialise in. Nathan, I bought some lemons and I'm thinking of getting rid of the last one this month. I'm now looking forward to move forward in the right direction. I'd love to have a review of my position with you and with the view of moving forward in the right direction. How can we make this happen? Sean, reach out to my team, send an email, send a message now, admin@binvested.com.au, buzz my office on 1300 367 925, speak with one of my investor relation managers. They'll get a bit of information. Generally, I've got 7 investor relation manager staff. I was one of the very fortunate businesses in 2020, which did very well. I've been talking about all of this financial stuff for many years and saw a big financial calamity coming. Saw this, people came to us very, very busy last year, like the largest year of growth we've ever had. I've got some very experienced investor relation managers to help that I work very closely with on a day-to-day basis, which they get information. If you've got a position that you want to share, they can get the information, they will run it past me. I will give them some notes as to what I would do, as if I'm Morpheus, you're Neo, I'm Morpheus, directing you how to get out of the acreage, how to get out of the acreage, seeing someone say acreage, get out of the matrix, and give you some feedback. And if you like what they talk about, then we could book in a one-on-one chat to discuss your position and work out a way forward of how we can help you reach your goals. How much cash/equity would you recommend to get started? You can get started for 10, 20, 30, 40 grand. Yeah, so small amounts of money could get you started. Can you source acreage properties under market value too? Yes. I've bought lots and lots of acreages. In some specific acreage markets, I'm very, very familiar and I have lots and lots of contacts in, depending whether they're in Sydney, whether in Brisbane, depending on where they are, I'll have a lot of contacts. So speak to my team and I'll give you feedback I'll give them feedback as to whether I can help you or not. I specialise in investment properties, but I do get acreages that are very cheap as well. So yeah, I've met Ridwan, great bloke. He is a gentleman, very lovely guy. I've learned a lot tonight, but it's also my kids' bedtime now. So thank you. I'll watch this video with my wife as soon as I get the email. God bless and good night. Good night, Rob. We'll talk soon. Thanks, Nathan. Fantastic contest. Curious to know, do you have a morning and evening routine? And if you are willing to share part or speak to how you would think of it. I don't watch any TV. I don't. When I go to sleep, I actually watch YouTube. I have things that I like throughout the day and different platforms that I watch from different content creators on the internet. So I do sometimes go on a light sleep and I listen to my phone. So I sleep, but I still think about what's coming in. So instead of my brain having thoughts of whatever I want to dream about, I can listen and learn along the way. I wake up in the morning, I spend about an hour looking at my email, seeing what has happened whilst I've been asleep, catching up on markets, looking at financial markets around the world, getting an understanding of what is coming in, a bit of learning, a bit of knowledge in the morning. Wake up, I'm not a morning person whatsoever. I'm not one of those 5 o'clock in the morning, get up and go to the gym. I'll probably get up about 9 o'clock, 10 o'clock in the morning, welcome myself to the world, have some bone broth in my breakfast, have healthy, nutritious fruit and whatnot for breakfast. Generally have lunch at breakfast as well. I know it's probably opposite the fasting. I get on with my day. I don't have to eat throughout the day. Go home, eat good food, catch up on all my emails, try and block it in the segments. So I used to find myself just looking at my emails and seeing what's coming in. I've got so many emails, so I just look at in blocks what I need to do. I don't let stress get to me. I carry a lot of stress because I've got hundreds of staff that are they're a part of my team. I've got all different projects that are running at all different times. I've got great people that are doing great things, which once again, it's the importance of the right team. Treat your property investing like a business. Looking at, I think I'm a pretty boring person. There's nothing really exciting that, but I don't want to go on traffic. So when I go on traffic or driving, I make a list of phone calls of people I need to call in the morning and on the way back. I texted someone just before and I said, can I call you at about 9 o'clock because I'm going on a webinar. So yeah, with it, I will call people on the way home, try and get maximum use out of my time. So yeah, so hopefully that may share a bit into my not so interesting life. Hi Nathan, I've been following you for a while. What fees do you charge? I'm a beginner. I have one property I'm living in. So there's a few different fees, from what we can do. Probably the first one would probably be a map session, which we can do a one-on-one strategy session. I'm sort of booked out at this point until I just think because I've got slides here to talk about as well. I'm booked out to about April, I think, March, April. But it's like a $495 hour of my time. Speak with me directly, give you a buzz, run through your position, give you some feedback, some pointers, ask me questions, whatnot. And then multiple different ways that I can help, whether it's buying properties or financing, or we can do your lawyer fees. There's all different parts of the business that I can help you. I can't help everyone on every part, but I can put you in the right direction. I've got very tremendous people around me. Keep questions coming through. Getting parched here. I'm going to go on to the next slide and talk a lot about. I'm going to talk a lot about things that I see people have hurt themselves from having the wrong people on their team. So I just noticed I had a missed call from my mum. My mum's 80, best mum that I could ever want. Love her dearly. I look after her. I try and be there and give her grief, make her feel young. She's about 80, and my mum, I love her. Right, favorite person in the world. I've got 100 people that work in my business. I could not have my mum in my business. Right, it wouldn't work. Right, it doesn't mean anything bad about my mum. It just wouldn't work. Right. So I look after my mum. She does little runaround jobs, and I make sure she has a very comfortable retirement. And she provided for me for best childhood that I could ever had. And I know that she's not the best person for my business, so I wouldn't employ my mum in my business because that would be an emotional decision, which wouldn't be the best. I want to have the best people that can do the best job at the best thing that they can do. And every time I've tried to put bad, like just, oh, this guy will be a good guy, we could get him to do this, or this girl's good because she can do that, it's always turned up and sort of not worked out well. You need people that specialize in guns at what they do. So having the right team around you. I see people that screw themselves up, whether it be from loans, people that get loans that are cross-collateralized, lazy brokers, people that are trying to trap you for 2 years. They fix your interest rate for 2 years, so then they don't get a clawback in the commission. Sometimes we have to charge a fee as a broker because we don't get paid like for doing the service. So sometimes we will give you the advice and whatnot, and charge you like a fee. I think it's like $1,600 to do so, but we're not getting paid from the broker to do that. So from the bank to do that. So brokers will just try and lock you up, and you want to know that the people that are around you have either done it themselves or done it for other people, or have a very, very strong knowledge of knowing how to do it. So yeah, make sure that you have the right finance team around you. Very crucial. Without getting money, if you didn't have money, you couldn't have done any of these deals. None of these people could have done these deals if they had poor finance structuring. Whether it's your accountant that's screwing up your structuring that doesn't work. I've seen accountants that go, we'll try and save you, all your tax, but you can't pay zero tax, earn no money, go get a loan. There's ways that you can minimize the tax, that you can have that tax bill very low, but also be able to service the bank. So you need to make sure that your accountant is speaking the same language as your broker. Most accountants, you ask them what is their succession planning for themselves, and they go, well, I've worked in the business for 40 years, and I plan on selling the business or giving it to my child to take charge once I can't run it. That's not really a smart, investor or whatnot. So you need to make sure that your accountant is investor savvy, business savvy, entrepreneurial savvy, to be able to understand how to get you to where you want to be. Have the right advisors around you. Financial advisors, I've seen screw people up so bad, whether it be trying to sell them commission-based financial services products, wrong insurances, etc. I don't give financial advice. I know financial advisors that I can put you in contact with, so if you need help, I can do that. Whether it's a buyer's agent. When I first started B.Invested, there was no such thing as an industry called buyer's agent. So we're real estate agents. I remember when I told people, I charge a fee for buying a property, they go, what? You're going to charge me to buy a property? I can go and find a property myself. Nowadays, everyone comes in and they're like, so what do you charge for your buyer's agency? And it's like, well, this is what we charge. And then they go, oh, well, yeah, this is about the same as everyone else. But what everyone else does isn't what we do, right? They just go, tell me what you want as a property. Okay, I'll go buy that property. I think you should buy this property because it's good. You're paying for their advice, their feedback, their belief system, their knowledge. When I'm making deals happen, I'm building your portfolio. So how's that property going to stack? It's not about property number 1 and 2 that you need. You need to worry about number property 6, 7, 8, 9, 10. If you screw yourself up at 1 and 2, 6, 7, 8, 9, 10 is going to be a distant thought of this webinar or distant thought of your goal not being able to be achieved. So just bear that in mind as well. So you make sure you've got the right people around you and on your team. I'm going to talk about properties that I'm currently working on, and I will answer some more questions. So here I've got a property which does not fit the bill of everything that we've seen tonight. It has not so great cash flow on it. Purchase price is $773,000 for the one that's left. I had a block of these apartments. This is just one of them, internal photo. But yeah, comparable sales, there's nothing under $1 million around. So we're picking up these for 773. There's probably 150 grand worth of equity in these. I did recently 2 similar sort of deals. One was in Parramatta. So in Parramatta in Sydney, a lot of you guys are going, where do I find deals? How do I make deals happen? Parramatta, $295,000. You tell me what part of Sydney you'll find for $295,000. I did a bulk deal of 8. We revalued them straight away for $410,000. Everyone pulled out the equity. They weren't the best cash flows. You can see 770, 500 to 600. It's going to be neutral, maybe slightly negative, $100 a week, $150 a week to hold this property. But if you could pull out that 150 grand equity and use that to go buy 2 of those other properties that give you $50 or $100 per week positive cash flow, then you've got blue chip property on the water in Sydney. You've got a solid portfolio there. So that's just one that is available. This here is blue chip. So if you are inclined, I do have one left probably gone, may have gone, like, you know, things are going crazy. Here we've got a property, a block of units, 350, comparables 450, rents for 700 to 800 per week. That's actually gone. It went this afternoon, so I'll move straight along. I think this one may have gone today, but 147 grand, comparable sales 180, $270 per week. This one here, yes, I know this one. 3-bedroom townhouse, 15 years old, $200,000 purchase price, $240,000. I actually just got a text message that this deal has gone. So, yeah, one of my staff messaged to say that someone had taken a deal, and I know that this one is not there. So this may be a little bit outdated and redundant already. I've got a block of land here, 10 grand. 10 grand for a block of land. I don't know how to value this. It's a half an acre. Rent on it. If you chuck the horse in there, someone will pay you $50 a week. That's 2.5 grand a year. I remember buying blocks of land like this in Binvested, in Western Sydney for $11,000, and I sold them for like $35,000, $40,000. Now they sell for $150,000 to $300,000. So when you talk about regrets, on the day, made 20 grand, it's cool. Made 30 grand, it's cool. But I have big regrets on some of those deals, and I'm not a buy and sell investor. I'm not a property trader. I'm a property investor. I like to hold assets that appreciate. This thing here is just a random little block. Got here a townhouse. The owner of this paid $340,000. I picked it up for $245,000, so it's about 100 grand less. So a few people have asked, should I go buy a brand new property off the plan? This is what happens when people buy properties off the plan. 350 grand. 15 years later, Nathan Birch comes in, picks it up for 245. You're like, I've had enough selling. And I pick it up cheap, and there's nothing under 300 grand for sale. So I'm making money from day one, and rents are sort of 350, 370, and it's got depreciation because it's modern, so it still has all the tax deductions. Here we have a unit. We actually had one in the same complex maybe like 6 months ago, which revalued. I think it was like 280, 290, something like that. 240 grand, rent for 260 in Sydney. If you need to get started, want to get started, email my team, admin@binvested.com.au. Give us a buzz, 1300 367 925. Staff don't bite. They're cool to help you. So on that note, I'm going to answer some more of your questions. Probably the best place to get started, speak to the team. If you want to get a strategy session, I do hold 4 days a week, 2 sessions a day. Sometimes, like tomorrow, I've got a purple folder that's on my laptop over there, which I've got 4 map sessions booked in. Some days they're really packed up. But yeah, it's like an hour of time where we discuss your position, what you're trying to do, work on a bit of a roadmap on how to get there. I'll give you feedback, answering your questions, etc. So probably the best place to start would be a map session. It's $495. It's an hour with me. I'm not selling my time. I don't like selling my time, but you guys need to put down some hurt money to be committed as well. Plus, I have all the operations that I do, which do costs. So I do charge for my time on that front. So it's probably somewhere to get started. Is a map session. If you need to get started, I see a lot of people asking about loan questions. Send my email my team, give them a call, and they'll put you in contact with my finance team. That could be a good place to start as well. So the strategy session with me, or a finance strategy session, and then maybe a map session with me. Look forward to being able to help you on that front. So a few more questions. Thanks for the webinar. I have to sign off now, but we'll watch the rest of the video when we get the link. Take care, John Beck. Have a good evening, guys. I'm 62 years old, a carer for my husband, sold my house and don't know how to invest this amount. So I have a place to live as well, giving me supplement income with my pension in the future. Borrowing might be an issue due to our age. I don't know. Some people we can't help with that. Some people there's different ways of what we can do. You may feel like you're only a person or that you've only got two people, but sometimes if you look at intergenerational wealth, you could do something with your children. There could be something you could bring to the table, etc. So who knows? Like, don't write off that you can't do something. Speak to the team, reach out, give them some information, like have a chat with them, give them some notes. Look at it from yourself, which is two-dimensional, but then look up, higher in the family or lower in the family as to children or parents or wherever you fit in your family unit. And there could be things that we could do collectively with your family. So reach out to the team, and if you just got a position, just speak to my team. Please also respect their time when you're talking to them as well. But speak to my team, give some information about your backstories, and they can bring to me a form. Like, I get them to fill out some data. I can look at it like I'm Neo with the code in the matrix, deciphering stuff, be able to give pointers as to what we can do. So I can have a quick sort of little look over your file and give feedback to my team, and you guys can work out what you want to do from there. Do you set up the loans as PP or IO, so principal and interest, I think you're talking about there, or interest only? I always set them as interest only to start off with, because why would you want to reduce your cash flow coming through and pay off debt when it's only 2 or 3%? My view is to pay down debt at the later part of your portfolio. So identify you in an accumulation phase or a consolidation phase. Even to this day, all my properties have been interest only. Then the rents rise, and then they go to principal and interest, and then the extra rent covers all the principal repayments, and the loan pays down itself without me having to look after it. Awesome work, Nathan. Look forward to receiving the link to rewatch this. Would love a link to your budget one also. Ask my team if you would like access to the budget, to the goal setting. It wasn't budget, it was a goal setting one. If you'd like access to the previous webinar, speak to my team. They can help you with. How much did you buy GameSpot for? I didn't buy GameSpot. I don't invest into pump and dumps. I don't believe in little scammy things. I have a strong belief system. I think Wall Street is full of crooks and criminals out there. Just as a side note for my opinion on that. But at the same time, I don't get involved. Like, these things people blow their fingers off with, and I manage risk very, very carefully. Just like Bitcoin, I'm a very big fan of Bitcoin. I'm a very big fan of cryptocurrencies. At $50,000, I am not buying into Bitcoin. Sorry. I do hold a very good position of Bitcoin, because when I got into Bitcoin, it was $500. So be careful with the risk. Like, how you're getting into something that could blow your fingers off. So a great webinar. I'm in South Africa and still found it extremely valuable. Really appreciate the feedback. I love the fact that I'm global, so it's cool. Everybody is welcome here from no matter what part of the world we are in. So hey Nathan, when you come across an awesome property, how do you decide which client gets it? I work with a list sort of process. As people come on board, they go on a list, go to the people that are highest on the list first. When they buy, they go back to the bottom of the list. Someone is painful and they say, I don't want a property, I don't like this one or whatever. Well, then that's cool. We go back to the bottom and we wait for the next one. So I want to make sure when I'm presenting a property to my investors that it's going to help them achieve their specific goals. So sometimes I've got people that are waiting a week, a month, 2 months for a property. Sometimes I have someone that buys 2 straight away. So it just depends on what you're trying to achieve. Does it help you achieve that? Will you benefit from it? And that's how I sort of present to my investors. Sorry to tap in so late. Would this strategy be harder in Victoria? I have people everywhere, as we just saw. South Africa, they're doing stuff all around the world. So it doesn't matter where you're located, you can still make cool things happen. Great webinar, Nathan. You're smashing it. Looking forward to continuing through the process. Got to go chat soon. You know who wrote that. I was talking about you beforehand. You're doing awesome work, mate. You've got, in a month, 2 months, you've reached your goals, so it's cool. Andrea, very excited for next week. Gemma has organised some time for me with Rose on Monday. When we're done, I'll book in for a map session. Awesome stuff. Look forward to having a chat with you, Andrea. Sorry, just losing my palate again, so I need some water. Such a humble individual. Well done, inspirational. Appreciate. Thank you. Do you ever worry about getting information overload? No. When I take information, I go, do I care about this? Is it important to me? Should I take an extra moment to process this or not? Make that decision. I see people go down rabbit holes and they get stuck. I don't like going. I like looking at things holistically. Like when I move very fast and I go done. But I've added all the data together. So yeah. Stephen, are there any jobs going at B.Invested? Would be interesting place to work. I'm always employing new staff. We actually just had to get another office in this building. I'm in the process of building my dream office. I'm exchanging on the property very shortly. They built an organic cafe, big farm, different wings to it. It's going to be situated on 5 acres in sort of the Hills District. I've got lots of properties. I've got about 10 different acreages out in the area, but I'm getting this one specifically because I like the location. I want it to be a holistic place, grow food there. We can have, organic food and serve it to people in a cafe out the front, which is separate to the rest of the group. But in the process, we've got to, deal with offices, and I've been in office for years, but we're expanding and growing all the time. So reach out. The email, I don't know what it would be. There's always jobs on Seek. We're always hiring for new roles. I've got a HR manager that manages all this stuff. So yeah, reach out to my team. Maybe the admin. Let's just keep it simple and go to admin at B.Invested, and they'll send it to HR if it fits in and we can work. So keep the Birch feed coming. I love it. Sometimes I don't have too much time to post each stuff on Birch feed, but I do try and pump that out when I can. So if you're not on Birch feed, it is free. Go to birchfeed.com. It's a website. You can register for Birch feed. You can set your notifications on mute, because I do post at all different hours of the day. I'm sure that a lot of people on there are probably thinking their spouse is having an affair by getting these texts at 2 o'clock in the morning sometimes and that. But do set it on silent and like for the notifications. And I do post a lot of interesting stuff. There's probably 10 days worth of 24-hour time worth of data in there to process, and some interesting stuff. So do you prefer to clients to have one-on-one session at first before starting? Yeah, look, I don't just buy properties for people willy-nilly. I'm sure there's companies out there, but I want to know who I'm helping, how I'm going to be able to help them, and understand your position to best serve them. So yeah, if you are working with me one-on-one, I would suggest a strategy session. If you do want to just use my other services, just reach out to my team and they'll put you in contact with whoever you need to speak to for whatever part of it. So I share my shared services of people that I've used. My broker Rose I've used for 15 years. So yeah. Hey Nathan, if I want to start investing with you soon, I'm assuming they need to line up and wait until April after the map session before we're able to start. Sometimes there is a shortcut way to that, which I do fit the equations into, do fit the appointments into the day in the schedule and whatnot. Hence why I've got 4 chats. The shortcut way is if you are signing up to become a buyer's agency investor, then my team fit those investors in within like 1 to 2 weeks, sometimes maybe 3 weeks, but it does sort of streamline it. Sometimes I speak to people real late, and sometimes I'll speak to them on a Saturday or Sunday if they're really lucky. But yeah, I will be accommodating for my investors that I deal with one-on-one. Lots and lots of questions here, guys. What have we got here? Sounding like Bill Gates. I would never want to sound like Bill Gates. If I ever sound like Bill Gates, reach through my screen and give me a big slap, because it's not someone I wish to sound like. So yeah, not a big fan over there. So yeah, I just wanted to keep this concise because I know that I could go on all the evening. I just want to thank everyone for allowing me as a part of your evening or day or whatever you're watching this, allowing me in your home, having confidence in what I do, in having confidence in my team. So yeah, if you have any questions, feel free to reach out to my team, admin@binvested.com.au. Call us at 1300 367 925, and look forward to helping you kick ass with your investing goals and making 2021 awesome. We'll catch up soon, guys. Bye for now.